Have you ever seen a price action like this and wondered how do I enter in such a price action? In this video, I'll show you how to predict the market every time using only one candle, introducing the candle continuity theory, and give you a full trading strategy based on that theory. You'll have another level of understanding after this video, something you never thought about on this way. First time I ask, make sure to like and share the video so more people benefit from it. Let's get into it. Now, before getting into the video, I want to make sure that you guys know that I've talked about this concept a few months ago, and it was used to find your daily bias and your trend of the market. However, on this day, we're going to take it to the next level and we're going to go deep into what is the candle continuity pattern. So the first thing that we're going to be discussing is the open high low close and the open low high close. So looking at any candle, right, what we see is this type of candle. We see high and a low. However, if we focus on this candle, what is inside of it, right? So what we have is, for example, this is, let's say, a bearish candle. It opens here and then it created a wick and then it closes here. But before that, it created this low, right? So inside of this, what we see is, okay, we opened here, we started going this way, and then we created a high of that candle. We started going lower, and then we created this low of the candle. We went up and we closed here, and that was the closing price. So that's what's going on inside of this big candle. That's the lower time frame, that's the higher time frame. So let's say if this is the daily candle, then that's what we're going to be seeing on the lower time frame. So or the 1 hour, the 15 minutes, or 5 minutes, and the 1 minute, whatever. Now, knowing this, that if price wants to go bearish, then it needs to go above the opening price to manipulate to get a better price before going lower, right? So that's something that we know. Before price going lower, if it wants to go lower, then it's gonna create the high first, and based on that understanding, the best time or the best price to sell in this case is gonna be above the opening price. Now, exactly the same thing when we have a bullish scenario. If we're having a bullish scenario and let's say it's totally the opposite, and let's just consider that, okay, we do this, we start here and we want to go up. Before that, what's gonna happen is price manipulating price lower. So we have the manipulation here below the opening price, then price is gonna shoot up and then it's gonna close like this, creating the wick or the high of the candle, the low of the candle. So where do we buy? Below this opening range, right? This is where we buy. This is the range that the best opportunity to buy is. Now, combining this with the candle continuity theory, right? So taking a look at any time frame, any asset, and any time of the market, right? When the market is open, take a look at this and I want you to think with me. Now, what is this theory? It's just something that I came up with based on the understanding of the market. And it's really something that's going to simplify the way that you look at the price action. And it's actually going to prevent you from taking some stupid trades. And you're going to know why. So taking a look at any candle, right? Any candle. And I'm going to specify later on the video where to focus most on this. Now, taking a look at this, starting from here, for example, we had this bearish candle, right? So this was a bearish candle. We closed bearish. Now try to answer this question with me. This is a bearish candle, right? So it was a red candle. It closed lower. What are we expecting the next candle to be in a logical way? Or if we have a bearish candle, then what is the probability or the higher probability of the next candle to be? Is it bullish or bearish? Actually, it's bearish because we want the same candle to continue on the same direction. So a bearish candle then most likely is gonna be followed by what? A bearish candle. You know, go take a look at any chart. You'll see that this is actually what's gonna happen. The higher the probability for the next candle to follow the same bias of the previous candle. So that's the candle continuity theory. Our sponsor, Blue Guardian, is the only firm that gives you a tool to protect yourself from hitting your max daily lows and prevent you from over trading. And it is very simple to use. They also have a new unlimited time evaluation with low profit targets and no trading days requirement, so you can get funded in the same day. Blue Guardian is a firm that I trust. Use the link in the description below and use the code MOLHAM to get 10% off your next Blue Guardian evaluation. The next candle closing bearish again. Since this closed bearish and also with a displacement, what is the next candle? Closes bearish. Now what is the next candle? Closing bearish again. And it continues like this, because if you try to find any, even if you are in a point of interest, if you try to find any bullish trade here, you're gonna be failing. And why? You're gonna be losing. What's the reason? is that you're not following how the candle prints. Candle is bearish, the higher probability for the next candle to be bearish. And again, this is a bearish candle, closing bearish again. Because this candle closes bearish, then expecting the next candle to be bearish again. And you see, it continued like this until we closed bullish here. You see, bullish candle, what does it tell us? That, okay, the next candle, now the probability is changing. Because we have a bullish candle, it means that the next candle would be bullish. And let me confirm this to you. This is going to work again on all assets. It's going to work on all time frames. So I'm using the 50-minute here, but if you switch to any time frame, then the probability of each candle following the previous one is still working. And let me also tell you this, what we're going to be going over the video is going to be more deeper than this. So we're going to know when to use this, when it's going to be the higher probability for this theory to work. And we're going to also go over a full trading plan based on this. But now take a look at this. What happened here? Price actually started going up all the way up until here. And when did it stop going bullish? So it was bullish here, it was bullish again here. We were just going up until we created this bearish candle. So what are we expecting now? Another bearish candle. And we're going to discuss those inside candles. You know, do not really pay a lot of attention to them, and I'll explain in details what to do about them. But you see, bearish candle started here. What are we expecting the next one? Bearish, and then bearish, bearish, bearish until we close bullish. We had an inside, but we went up, then it closed bearish, inside, bearish, 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 inside, bearish, bearish. So you see, it continued going lower, and this is simply the candle continuity theory, okay? So simply price continuing on the same direction of the previous candle. When this candle closes bearish, based on the open high low close and the open low high close, where do we think is a good price to actually enter based on this, right? So we have a bearish candle. What are we expecting the next one to be? A bearish candle. What is the best price in here to go short? What is the best one, or what is the best range? It's actually the closing price of this candle, which is the bearish one, which is our candle, the first one, and then the opening of the next one. So this was the opening level. Closing of the first candle is the opening of the next candle. Where do we look for shorts in this case? And let me show you exactly above the opening. You see, really sniper entry you got here on the lower time frame. So you're going to go to the lower time frame and look for an entry here. The same thing goes here. So this candle closes here. It's also the opening of the next candle. Where do we look for these sells? Above the opening price of the new candle or above the closing price of the previous candle, right? So this is the one exactly right here. Now again, closing price here started this time, maybe because of the broker data or just because price was in a hurry to go lower. It did not create a wick. The same thing here. But then again, this was the closing price. Price literally just wicked above and then started going lower. And again here. So here, there was actually no wick. But then again, let's see the bullish scenario. So right here, we close bullish. What are we expecting the next candle to be? To be bullish, right? So where do we look for the longs? Actually, closing price of this bullish candle, which is the first one. And then the following one, the opening price of it. We buy below. There you go. That's a very nice entry below the opening price. Price started going up. What did we close? Bullish, right? That's the closing price of the first candle, opening price of the second candle. Where do we buy? Below the opening price. There you go. Following the same logic. Bullish, then we're expecting prices to go below the opening price to find longs. And there we go. It continued the same. So you see, perfect entry below. Then we close bearish. Where do we look for sells? You see, just right here. There you go. That's your sells. And then price going lower. And it continued the same and the same. So let's just have this rule very clear on the theory. In order to buy, we need to buy below the opening price of the next candle. If you want to sell, then it's going to be above the opening price of the next candle. And know that closing price of the first candle is the opening of the next candle. They're equal to each other. So that's the buy and sell. So you see, for example, if we go to the lower time frame, I'm marking those levels. And let's go in this case from 15 minutes to 1 minute. Now take a look at this on the lower time frame. This is opening price, right? And price was only coming to an order block to fill that order block to go up. Again, opening price here, price was retracing lower to go where? To a fair value gap in this case or an order block. Again, the same thing. Now going up, price was coming lower here. It just wicked below to, come to this fair value gap, which was potentially going to be a fair value gap. But also watch my video about fair value gaps, which is going to be suggested now to know that, okay, this fair value gap is not going to be filled based on the third candle of the fair value gap. Now going up again, you see price was retracing lower to come to this order block. Now again, This is a bearish scenario. And what happened here? Price was actually coming to this fair value gap when it was retracing. Opening price here was going up to this fair value gap, starting going lower. And it happens over and over. So we're going to be discussing this on details, do not worry. But now I just want to focus on the candle continuity theory and make sure that you guys understand the relationship between the candle continuity theory and the opening price. Now going over when does the candle continuity theory work the best. So there are specific areas or specific times where this really works the best, and price is really going to give you those good entries. And the first one is when we are in a point of interest or also in a market maker's model, and also followed by a liquidity sweep simply. You see, after this liquidity sweep, we had a bearish candle and then it continued lower. Now, why did price give a really nice entry here, and then the CCT was given good entries also here? Because we are in this fair value gap. So price reacted from this fair value gap, right? And then immediately a very nice bullish candle, followed by another bullish candle, followed by another bullish candle, and the opening price was giving you some good nice entries, right? And then when does this end? When we are in another point of interest. And this one actually was part of a market maker's model. So this was the buy side of the curve, and this was the sell side of the curve. So when you also in a market maker's model, it's going to give you some nice entries. And you see from here all the way to here, very nice CCT, right? So price was really respecting and following the previous candle bias. There you go. So this is the first one. The second one is when we have a momentum candle, or in other words, an engulfing candle. So anytime you have a momentum candle and not a weak candle, so we always think about the respect and disrespect, the continuation and the reversal candle. So you see an engulfing of this candle, even though this the first one is an inside candle, you can enter based on this on the next candle, which is a momentum candle, an engulfing candle. You could also avoid this if you wanted, because this one did not close below the previous one, but the next one did. So you could also actually just focus on this candle, which is the momentum candle, which is the one that closed and engulfed the previous candle after a liquidity sweep. Then an engulfing candle, that's your one, that's your momentum candle. So always focus on those ones and do not focus on this one. For example, this one was a reversal candle after a liquidity sweep. So we're not actually expecting another price just coming below the opening price in order to continue up. No, because the reversal already happened after this liquidity sweep. There's no continuation after that. However, the continuation is gonna happen to the lower side. That's what I'm looking for. So a bearish candle here, that's what I prefer more than a bullish candle to the upside, because we already swept this liquidity level. So that's one of the ways to look at it, right? And also, you see this one, what we had is price coming into a point of interest. We could break above it, yes, but then we had another bearish candle and then followed by another bearish candle. We have a bearish candle followed by another one. So now I'll be trusting the CCT more than anything here. Why? Because we're already in a point of interest, and there was a reversal here. So this candle had a wick going lower, and this candle followed the previous one. Now we're starting to go lower, and then you see 1, 2 inside candle. So there was no price going up, followed by an engulfing candle. So you can trust this more than the other candles, and then it continued lower. So the momentum candles, for example, this one, you can really trust the CCT to work here. Now the third condition when the CCT really works is the clear draw in liquidity. So we can see that when price was coming to this fair value gap, and if you watch my market makers full course, then you would know that, okay, the smart money reversal happened here, and now we have a very clear draw in liquidity, which is this low right here, right? Because that's the external liquidity. So when you have a clear draw in liquidity and also a low resistance liquidity, which means displacement, then the candle continuity theory is going to work the best. Why? Because now we have displacement, we have a clear direction that we're going into, and all candles would respect the previous ones when it comes to the bias. And lastly is the kill zones, or times where we actually have a lot of volatility and we have a lot of volume. Because if we don't follow this, the last one, which is the kill zones and the high volatility conditions, then we're going to fall into this. You see this range here? You see that we have a bullish candle. Okay, it was followed by another bullish candle. However, then it was just a miss that we could have a bearish candle, a bullish one, a bearish, a bullish, bearish, bullish. So there is no clear direction when we have low volume. And if we consider this time, what is this time? 20 until go to the landing kill zone where the volume, the real volume starts. So you see trading on the Asian session, it's not really beneficial that much. Sometimes it's going to work, but not every time. So we really want to focus on the New York kill zone, London kill zone, and days of high volatility. So even Monday sometimes it's not going to work because it's lower in volatility. The other days are going to work perfectly. So you see, for example, those times, this was the PM session, and then it works sometime, but not as good as those ones. So you see, the start of the London kill zone at 2 a.m., we have a clear direction going lower here. After taking this liquidity level, closing below, so there was no displacement here, closing below, opening price, sell above, opening price, sell above, opening price, sell above, and then opening price here, sell above. This was an inside candle. It was not a, a reversal, big momentum candle. We keep going lower, sell above, and then until we get this candle. And here, after the London kill zone ended at 5 a.m., then the volatility went lower. So only focus on the London kill zone and your kill zone to have a better results on the candle continuity theory, okay? Now, since we know when it works the best, then we can do the opposite to predict when it's not gonna really work. Now, when it's not gonna work, when we have no volume, low volatility day, ranging session, for example, Asian session, and then when there is a disrespect candle or reversal candle. So when we see that, okay, we are having a liquidity sweep and then price not closing above and reversing already, this is a disrespect candle, then it means we are looking for a lower prices. So I'm not going to be trusting this bullish, and I'm not going to follow the candle continuity theory here because it doesn't really make any sense. We already, based on the rules of the CCT, we're having a reversal here, not a momentum candle, so not following this candle bias. We could go to the opposite. Now into the part that a lot of you guys waiting for, which is a full trading plan or a strategy based on the candle continuity theory. So let me be clear here. You guys have the freedom to go with whatever you want. So you could create your own trading plan, be creative with it. You could execute this on a market maker's model. You could execute this after an inversion fair value gap. You could execute this on a scalping setup, whatever you want. But what I'm going to be giving you today is a mechanical way for this approach. So it's going to be a mechanical setup that happen all the time on different time frames. So you could use the same time frame alignment that I give on the market makers model video. So make sure to watch that video if you want a time frame alignment. So for example, a 15-minute would be a 1-minute lower time frame, a higher time frame of a 4-hour would be a 15-minute lower time frame, and it goes on and on. So the focus of the setup would be on point of interest. That's the first thing we need to identify. So you're going to go to your time frame. For example, if I'm considering the 50-minute for my higher time frame, I'm either looking for a fair value gap, I'm looking for an order block, or I'm looking for two things at a time, right? I'm looking for a sweep into a fair value gap. This could also work. Now, what is happening here is, okay, we have this fair value gap. We also have this fair value gap, right? So how do I know which one to execute? Because price reached both of those. So why not entering from here, you might ask, and why entering here? The thing that we're going to be following is a creation of a swing high or a swing low inside of a point of interest. So the first thing is we need to find a swing high, a formation of a swing high or a swing low in that point of interest. And what is a swing low? So you see candle here closing, we have another candle closing lower, for example, right? This is still not a swing low. Now another candle going lower. This is still not a swing low, right? What is a swing low? When we have a candle going up like this, what are we creating here? A low that has a higher lows on both sides. So to the right and to the left, we have higher lows. So when we go and create a higher low other than this one, then this is a swing high formation. So you see, when we're coming here, we had no swing low formation, no swing low formation, no swing low formation, because this one, if it closes above this line, or if the low of it was above, then that's going to be a swing low. However, we don't have a swing low until when this candle closes, right? So what happened is this low, lower low, and higher low. We're going to be waiting for this formation or this pattern to happen before executing any trade. So it means that this fair value gap was disrespected. We're going to forget about this one, and we're going to only focus on this swing low formation. Now, let me show you the other one. So you see, we had this fair value gap as well as this one, and then we have one below it, right? We also have this one, and then one here. Most likely this, we're expecting this not to hold because it's not the extreme one. It could hold, but we did not also have the swing high formation at it. You see here, we did not have a swing high. We closed above it, at this fair value gap, and this one we did not come to, so we're gonna remove this, and this one was disrespected, we're gonna remove this. What do we see here? What happened here is a swing high formation. This is a high, so you see this high, it created a high here, but this one was a higher high, so it did not create the swing high formation between those three. However, from this high to this higher high, and then a lower high here, so that's a swing high formation. So at this fair value gap, we created a swing high formation. Now looking at another one, we have this fair value gap. Did we create a swing high formation? Yes. Where did we? You see, high, higher high, and a lower high. So that's a swing high formation. Now looking at those three examples here, where we have a fair value gap and we have what? A swing high or swing low formation on it. What we're going to do is we're going to participate on the trade on the fourth candle. So we have the 3 candle formation, which is the swing low. Our participation is going to be on the fourth candle. And how we're going to approach this? The closure level of the 3rd candle of the swing, which is going to be the opening price of the next candle. And we're going to execute on this. So looking at this, for example, that's our closing level of the 3rd candle and the opening of the 4th candle. We're going to go to 1 minute, which we see here. This is the opening price. Now, after the 5th candle closes, we have our opening price. We want to look for any type of entry on this time frame. So what do we see? You see how price opened here, started going lower to this fair value gap. That's an entry for you, right? So you don't need to have limit orders here, or, you know, follow whatever you want, because this is just simply an entry type based on the candle continuity theory. So feel free to follow any setup. But you see price come into this fair value gap, the reaction of that fair value gap, and then we have an engulfing closing above the last bearish candle, which is now, this is a change of state delivery. So you could enter from here after the change of state delivery, stop loss below here, below this low that price came to, this fair value gap, and then targeting what? You could target whatever you want, right? Now, let me make this clear. In this swing low formation, if we have something like this, and now let's consider that 3rd candle had this wick. So you had a wick that was this big. Now, this is the opening price of the next candle. So we're looking for a setup below this level, right? Now, if price comes here, we have a fair value gap on the lower time frame, and we enter here. The first and the easiest drawn liquidity is going to be this high. A wick here, that's going to be the easiest drawn liquidity, and that's your first target. And then you can extend it more to the upside. Now, if you go to 15 minute again, and look at that same example where we had this, we could look for, you know, this fair value gap to be filled. That's your first target. Then look for some reactions of those fair value gaps. Now, following the same framework, we have this swing high formation inside of this point of interest. It was confirmed here. Whereas the closing price of the 3rd candle and the opening of the next candle, it's right here. Now, if we go back in time, and let me make this clear, right? We have this opening price of the next candle. We're going to go to 1 minute. Now, using the replay here just to make it clear, we had this opening price. So this was the swing high, right? This is the 2nd candle. This is the 3rd candle. Now we're participating on the 4th candle of the swing high formation, right? After the swing high, the 4th candle, simply looking for any type of entry above here. So few scenarios that I'm expecting is for this high to be taken, sweep above coming lower, or this order block to be respected, because we already reacted from a fair value gap here. So feel free to follow your setup here. Price is going up. There's no fair value gap, nothing clear here. Price is coming to this order block. And then we have, okay, we have a change of state delivery. So you could participate on this change of state delivery, or you could wait for this inverse fair value gap to be activated. Whatever you feel, stop loss is going to be, you know, a safe way is going to be all the way above the swing high. You know, I don't want to sacrifice a lot of the reward to risk. So I'm going to put it here because I feel like the last line of defense is going to be this high. Closing above it is going to be the last line of defense. And then I'm going to go all the way to, let's say, this fair value gap. Or I'm going to go to 15 minutes simply and look at what I have. If I know that I'm part of a market maker's model here and you're good at spotting those market makers model, then your target is not going to be only a fair value gap here. It's going to be this external, and then we keep going lower. Now, again, we have what? Another point of interest left here. And if you can confirm that you're in a market maker's model, you know that you're going lower. We're going to wait for a swing high formation inside of that fair value gap. And we can confirm that happened here, high, higher high, and lower high. So that's a confirmation that, okay, we had our swing high formation inside of this point of interest. Now, what is the way of entry? This is the closing price, and it's the opening price of the next candle. We could simply go to the 1 minute and look for any type of entry. Simply, we see that we have this liquidity level and a fair value gap above it. or we have this fair value gap. Whatever I see a change of state delivery from, I'm going to be entering. So there is sweep of this high, but no change of state delivery. And now we have a change of state delivery. So you could enter here again or wait for this high to be taken. But even, I'm just going to go like this. Stop loss above this high, right? Or above this fair value gap, and then targeting the same level, right? And this is a 2.721. You could actually go with a little bit tighter stop loss, and that's a 3-1. And then you see price started coming lower, goes to that level that I was actually anticipating to enter from, but we already had a change of state delivery here. So I don't want to miss the trade. Now keeping price going lower and lower and lower, you see price is approaching that level and taking the external liquidity. Now, even taking a look at those candles, even on the 1 minute time frame, the candle continuity theory works actually. So you see, we closed bearish here, another bearish, and where did we sell? Above the opening price. Again, where did we sell? Above the opening price, we started going lower. Where did we sell here? Above the opening price, and again here. And it keeps happening and happening over time. So you see, when you're really on a point of interest, it happens easily. Now, looking at the daily time frame, for example, on your USD, just to prove that this actually works on all time frames, but with the right time alignment, we can see that, okay, we had this fair value gap, for example. When did this fair value gap held the price to go up? When we had a creation of a swing low. So you see, this is not a swing low here, but then the formation of this low, this lower low, and this higher low is the swing low formation. So after that, if you just put your stop loss a little bit below this, depending on your entry, then that's going to work. Now looking at this fair value gap here, the other one. So this is, just going over any point of interest, randomly, and looking for a swing low formation on a bullish scenario. So you see, what we had here is this low, this lower low, and this higher low. Buying below the opening price would also work. Now looking at this fair value gap here, this bullish one, again, price came to that, created a swing low formation, and then started going up before coming lower again. Now taking a look at this, for example, this sweep here, we had a sweep with a swing low formation. This is your opening price level, right? Opening price, buy below to go up a little bit. Now another one into this order block. So if we look at this order block again, price came back with a sweep, creation of what? A swing low. There you go, 1, 2, 3. So we participate on the fourth candle. There you go, that's your opening price. Buy below here, this is your buying range, right? This is where you buy, and then price started going up. Now exactly the same thing. We have this bearish fair value gap, right? And when did we have a swing high formation? So this one, no, because this is a high, higher high, and then a higher one. So at this point, this one, and this, we had a swing high formation to go lower. So that's your opening price. Price started going lower. You could benefit from this, but the real benefit would be from the next one. We had a sweep into that fair value gap, right? And then what happened after? There you go. We can see that a high, higher high, and a lower high. That's a real swing high formation. Again, we have this opening price. There you go. Buy above. This is your buying range. You buy here, and then price started going lower. And again, you could do the same thing here and benefit from those levels, right? It's really simple, really works if you know where your market section is, where your drawn liquidity is. So you could still create your own way of using the candle continuity theory, and make sure to tag me on Twitter. Say, okay, this is my way. How do you think about it? And I'll get back to you. There's going to be more videos in the future about this, how we traded, maybe a back testing about this specific model. If you wanted, then make sure to mention this in the comments. This is Molham, and I'll see you next video.